Hello, hello, and welcome to Portfolio Matters Week 23 Weekly Update. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, let's go through this week's update.
Thank you, Richard. Okay, so doing the Portfolio Matters podcast has been a learning experience, and we have gradually become more structured, and that will continue. So we have actually found better sources for the weekly economic news, and there is a lot of important economic developments at the moment. So going forwards, we will attempt to be more thorough in our coverage of economic indicators. Now, this week was an absolutely extraordinary week. First of all, on the ECB kept rates unchanged, but then stated that it will maintain or even increase its emergency bond purchase program. But the big news for the week, and news that I find, and the effects of which I find absolutely mystifying, were that last Friday, after we recorded our weekly, US non-farm payrolls came out, and they were very strong. They were plus 559,000 jobs in May. However, expectations were for 671,000 jobs. And on the back of that miss, bonds rose very strongly. So yields fell, which I find extraordinary, because the other news was that inflation continues to run hot. So just running through these, US employment rate fell more than expected, fell to 5.8% against expectations of 5.9%. The job openings rose to 9.3 million against expectations of 8.2. And related to that, the US Small Business Optimism Survey actually fell on the month because small businesses are worried about inflation and they're finding it difficult to hire staff, as evidenced by the job openings. US CPI was 5% against expectations of 4.7. Core was 3.8% against expectations of 3.4. So inflation is running hot. In China, producer prices were 9%, although core CPI remains subdued currently. In the UK, construction PMIs were very strong, 64.2% against expectations of 62.3. The one negative during the week was UK industrial production, which actually fell by 1.3% in April against expectations of plus 1.5%. So that is a big miss. And in March, it was plus 1.8%. So going through a few of these, and the thing that I found absolutely mystifying during the week was the extent of the rise in bond prices and the fall in yields. And so this is a chart from John Authors of Bloomberg, which shows the effect of that payroll miss. There was an immediate purchases of US treasuries and falls in the bond yield. I mean, Richard, do you have any idea what's going on? It seems extraordinary to me, the strength of this.
Yeah. Well, I mean, I think it's very difficult to understand it because logically, what's going on and with the inflation data as well, you would expect bond yields to be rising. So I think there are three sort of potential explanations. One is that people have just lost their senses, but I don't think people have lost their senses. So are large investment managers, have they got an incentive to buy bonds that we don't understand? And if so, what is it? And or are the central banks manipulating the interest rates? Now, I think it's absolutely crucial for central banks that they keep interest rates low for reasons we've discussed in the past and people are familiar with. And maybe this was an opportunity to strike and get the yield down a bit because take advantage whilst they can, knowing that the CPI was going to come through strongly in a couple of days' time. But the situation is that the Fed has a 2% inflation mandate. It's saying it's going to allow it to vary around that mean. We're now at 5%, and that is a big variation.
Absolutely. And yet, the inflation numbers, the bond market took completely in its stride. And then the payroll numbers, which came in, marginally worse, but still very strong. There's this big fall in yields.
The only logical reason you take it in its stride, all other things being equal, is that you expect it to be extremely brief. In other words, in the next month, it'll drop back down to 2%, I presume. And if that's what you expect, then maybe that explains it. But I don't think that's what's going to happen.
No, I agree. The only other thing I'd add, Richard, is that there is an awful lot of money searching around for yield. And, we've seen that the US banks are absolutely flush with money, and their US Treasury holdings have enormously increased at yields of essentially zero or below. Yeah. And so perhaps the payroll numbers just gave them the okay to go and search for a bit of yield in treasuries, because 1.5% is better than zero.
I guess if there's a lot of money searching for a home as well, the stock market probably isn't the place you want to put it if you're worried that there's going to be a significant correction. And maybe it's the lesser of two evils.
Yeah.
For managers with a lot of funds on hand.
Yeah. But I find the performance of the bond markets this week absolutely extraordinary. I think we're living through extraordinary times. Okay, moving on. So this was the jobs report. So you see that unemployment fell to 5.8%, and we have another interesting chart coming up on the composition of that. But jobs growth was strong, but
I think the labour force participation rate is falling as well, isn't it? So these unemployment numbers should be sort of understood in the context of the overall number of people who are actually apparently looking for work. Because I think if someone isn't looking for work or has been looking for work for, is it 6 months or 3 months, they drop off these numbers?
Well, the other thing to say, Richard, is that we know job openings are absolutely enormous. They're 9.3 million, was it?
Yeah.
And yet jobs growth was only 560,000. So there are plenty of job openings. It's just people aren't willing to do the jobs at that price.
Yeah.
Now, what is currently happening is wage growth is fairly subdued as we'll go on, but it surely is only a question of time before employers start bidding up. And this is the National Federation of Independent Businesses in the US, their business optimism chart for small businesses. And you'll see it tick down slightly because small businesses can't get the staff and they're worried about inflation. As we discussed, job openings at an all-time high, and firms are finding it difficult to attract staff. As Richard was talking about, the inflation in the US has hit 5% compared to the Fed target of 2%, but bond yields are quiescent and in fact falling. Now, I thought this was an amusing chart, actually. This is a chart of UK GDP year on year, and it's up 28%.
It is a dodgy GDP graph, isn't it? Because basically it's comparing it with a very, very low figure a year ago. And
no, absolutely. Yeah.
It's what's the next chart, Keith?
Well, this I thought was interesting. UK industrial production fell 1.3% month on month. Now, we know the economy is actually doing all right, so services are growing strongly. But I wonder whether we are beginning to see the effects of Brexit and the inability of us to export goods as well as we used to.
I wonder whether car production is down because of this chip shortage. I don't know whether the UK manufacturer's been affected that way. Could be an element.
True. Yeah, good point. But construction activity is very strong.
A lot of that must be domestic and residential work, because I don't think there's a great deal going on in office buildings, commercial.
Absolutely. Now, I thought this was very interesting. This is from Robert Armstrong at the FT, and he is drawing an analogy between current market circumstances and the development of the Japan bubble in the late 1990s. And what happened in Japan in the late 1990s was they had strong GDP growth, but lax monetary policy, and a growing money supply, and a stable currency. And now we have all those circumstances right now. And as a result, equities and other assets went through the roof. And so what he's saying is that the current rise in equity prices and asset prices could well continue, but ultimately there will be a reckoning. But for now, very much stick with it.
This is a very interesting chart, Keith. It actually suggests that if this follows precisely, then there's potential for around about a threefold increase in US equity prices up to the peak, and then they'll drop by 75% over the next 15 years.
Well, the thing is, Richard, I'd not be surprised. You know, one of my big predictions is increased volatility.
Yeah.
You know, and
look at it's extraordinary, Keith. On the right-hand graph, the US PE multiples in Japan. So Japanese PE multiples dropped from about 85 down to, say, 12.
Yeah.
I mean, that's extraordinary size drop.
Yeah.
And that's you don't want to be underneath that.
No, absolutely. But, you know, that's lost decades.
Yeah.
And a great deal of economic pain.
I wouldn't be surprised if that's where we're going, because there's so much stimulus still in the pipeline, sloshing around. There's all this money, nowhere for it to go. Negative real interest rates. I wouldn't be in the least bit surprised. And central banks desperate to support markets, because that gives an illusion of economic health.
Absolutely. And of course, what happened in Japan was that lax monetary policy and growing money supply allowed an enormous debt bubble. And then when the bubble burst and asset prices came down, your asset value's gone down, but your debt remains. And then you spend 15 years trying to pay off the debt.
Yeah. And it's the term for it is balance sheet recession, isn't it, Keith?
Yes, absolutely. And on that note, unsurprisingly, everyone is bullish. Richard.
Just a graph on UK COVID. So I think the point with it here is that with the large numbers of vaccinated individuals, although we have the current case numbers going up, it's mostly in younger people who haven't been vaccinated. And the question is it going to lead to new hospital admissions and new deaths? Will the NHS be overwhelmed? That is the question. And at the moment, it's looking somewhat positive that new admissions aren't going up at the same rate as they did previously. And the death rate is much, much lower and going in the opposite direction. And that is good news for the effectiveness of the vaccine if this data continues to reflect what's going on here. And of course, this is what the government's absolutely desperate to try and find out before they finally release the mooted date of 21st of June, which I think they will probably defer now for a month so they get more data on these graphs.
Yes, thank you, Richard. You are injecting some sense into this debate, and I'm just not sure that the government is going to follow you.
I actually think Boris Johnson, he has various faults, but I do think he has a visceral understanding of what destroys an economy.
Right. Yeah. Well, do you think we're going to have another month's worth of lockdown then?
I think we will. I think we'll have a month's worth of not releasing it any more than it is currently released.
Okay.
And then I think the data will show that the hospitals aren't being overwhelmed and the death rate is still low.
Good.
Oh, so this is shrinkflation, and we all know, don't we? You go to the sweet shop or Sainsbury's or whatever, and you buy a Yorkie bar or petrol station, and or your Snickers, and it's like, where is it? The packaging's the same size, but I can't feel the bar inside it, and it's quite astonishing the numbers. The City Inflation Surprise Index. I don't think we're really surprised by it, but clearly there's a lot of news out there which is indicating that inflation is higher than people expect it to be. And the interesting about all of these inflation figures is they are going straight up. They're not sort of going up in a sort of little bit of a zigzag way. They're just going up vertically at the moment, which is really quite concerning, the rapidity with which it's all rising.
And this is before wage inflation picks up. Yeah.
So I persuaded Keith that we should leave this one in from last week. I think it's quite a handy graph. It just keeps you sort of focused on what Nordea are saying. Actually, inflation's got quite a long way further to go. So we're now at 5%. So this line is actually tracking the Nordea graph quite accurately. They're predicting it's going to go up to 7.5% before a fairly quick fall back to 5%.
Now, I thought this was an interesting chart, and this again is from Robert Armstrong at the FT. Now, the blue line is 5-year forward, 5-year expected inflation rate. So it's what the expected inflation rate is in 10 years' time. And the orange line is the 10-year Treasury yield. So what this is showing is that market inflation expectations have not come down over the past week or past couple of months, but Treasury yields have. So what's happened is that investors are just willing to accept more and more negative real rates.
Yeah.
Richard.
So interesting graph. Emerging Asia is no longer exporting deflation. So we know it exported deflation for the 2 decades, basically, from late 90s. And it is no longer doing so. And what this chart is suggesting is that it's following some curved trajectory, and it's going to start exporting inflation shortly. And of course, this is a very important factor in the West's low inflation rates. In that a lot of consumer goods have been very cheap due to cheap labour in emerging markets. If that is coming to an end, one source of inflation control is disappearing, and that of itself is clearly going to affect the future inflation rate. So I think this is definitely one to watch. It hasn't gone positive particularly yet, but if it were to go positive over the course of the next few months, then I think that would make that would be quite severe for inflation projections and prospects in let's say the G7 countries.
Sorry, Richard, when you say it's not gone positive yet, hasn't it? Isn't that showing 5% inflation?
I'm looking at the line graph at the top, Keith, where it's gone from 100 down to.
Oh, I see.
70,
right. Okay.
Along.
Yes, but that's over, last 20 years, isn't it, Richard?
Yes.
So it's just picking up recently.
Yeah.
But the thing I would say is that recently we have seen essentially a retreat from globalization everywhere, everyone talking about trying reshoring things.
Yes.
Also, we currently have supply chain difficulties which make importing difficult and increase the costs of importing. And also the big drop in prices from globalization was caused by essentially an enormous number of Chinese workers coming into the global economy, and that has now ended. Yeah. So I'm completely with you. I think we're going to see an end to imported deflation.
Yeah, and actually, just on that, the spike up to 5% now it is another vertical spike, isn't it, Keith? There's nothing gradual about it at all. It's simply gone bang.
Yeah. Richard.
So this is we talked about this last week, which is where the US core CPI doesn't include house prices. It includes a sort of a owner's equivalent rent of residence. And you can see here graphically the difference between those two numbers. So if you're trying to buy a home, then your experienced inflation rate is much higher than core CPI.
Yeah, there's a lot of squeezed middle classes and hidden unhappiness in this chart, actually.
Yeah, yes, there is.
Okay, now I thought this was interesting in that one of the websites we look at, MarketWatch, has started creating this inflation dials, which it aims to update constantly. And what's interesting to me is that this has really entered the national consciousness in the US, that inflation is something that is being talked about and is a worry. And that matters because as people start becoming concerned about inflation, so they start agitating for wage rises, etc., and it could become baked in. So interesting.
It's really interesting, Keith, because the other thing that I personally cast aspersions on last week was that inflation expectation graph. And this is, which was basically showing that inflation expectations were not rising. I passed the comment, I'm not quite sure whose expectations they are. But looking at this, it wasn't the expectations of consumers, and clearly their expectations indicate a level of concern.
Absolutely.
Okay, so we had this last week. I think it's been updated actually. Got it off the World Food Situation, the FAO website. So again, it just shows that world food prices are still climbing rapidly, and this is not a recipe for happy populations.
Yes. Now, we did do a poll on our Discord asking whether our viewers wanted us to cover every week food commodities and agricultural commodities. And the answer was no, actually, but we will cover it occasionally. And the bottom line is it's still a cause for concern. And on inflation, this is the price of container shipping, container rates, and it ain't coming down. It's continuing to surge higher to an absolutely astonishing extent.
There does seem to be a huge bottleneck in supply lines, and I saw a photograph this morning, I can't remember what it was on, of a rank of container ships fully loaded, waiting to unload, and it was pointing out there's this enormous bottleneck in ports. Now, whether it's because ports have introduced all COVID-safe working practices, or whether there is just more trade going on than they are capable of coping with, I don't know, but something extraordinary is going on. I also saw an article which said that the container ship manufacturers are absolutely inundated with orders.
Yeah.
Which is presaging the next crash in container rates, presumably.
Well, of course.
3 years.
Yeah. That's absolutely the capital cycle in action, isn't it, Rich? And actually, if any of our viewers have a better understanding of what is causing these bottlenecks in the container economy, please can they get in touch?
Definitely.
Richard.
So central bank real interest rates. I mean, some of these real interest rates are extraordinary, including the US's minus 4.1%. And very few of them are, in fact, here they're all negative, aren't they? You know, we're in this bizarre world with hugely negative real interest rates.
Yeah, absolutely.
So why would anyone buy a bond? Keith?
Now, I thought this was interesting. Essentially, US wages have not kept up with inflation so far. Inflation has surged, and although wages are rising, they're actually year on year, they're negative real. Now, I think this is pretty unprecedented, and you would have to say that wages should now start to catch up. And you've seen how the massive number of job openings in the US that are not being fulfilled. And there is a difference between advertising a job at an increased wage and actually that job being filled at the increased wage. Now, we know that that employers are advertising at increased wages, but they're not getting filled. And so I think as employers bid up and those jobs are filled, then the wage rate will increase. But right now, it's kind of theoretical.
And interestingly, Keith, looking at this data, basically the US wage element that makes up CPI hasn't moved. So the CPI move is without any significant increase in wages. So I don't know what percentage wages would make up of that CPI, but when wages start to move, there's going to be an additional chunk of inflation going into the CPI number.
Yes, absolutely. Now, last week we covered this, which shows how the relative performance of the S&P 500 can be explained by increases in earnings growth over the last year. So essentially, the next 12-month PE ratio of the S&P 500 has not changed. So all the growth in the S&P 500 over the last year can be explained by increases in corporate earnings. However, regular viewer and friend of the podcast, Stuart Owen, has sent us this chart from GMO, which extends the timescale over the last 7 years. And over the last 7 years, it's not very encouraging. Essentially, asset prices, equities have massively outstripped earnings. And GMO draw an analogy with the 7 years running up to the dot-com bubble. Something to be aware of.
And that is, Keith, that is consistent with the graph of US markets lagged 37 years versus Japanese markets.
Yeah.
It's the same effect, isn't it?
But I mean, the thing is, you've seen how negative real rates are, Richard. There's nothing to stop this going through the roof.
No.
But Morgan Stanley's market timing indicator is at its most bearish ever. And actually, it has quite a good history. I mean, it seemed to have timed the 2000 dot-com bubble and the bursting of the great financial crisis quite accurately. But of course, you don't know how much data mining has gone into this, frankly, and whether those previous points were contemporaneous or have been backfitted. I strongly suspect the latter.
And also, I would agree with you, Keith. But also, we had no QE, even the GFC. There was no QE, and I think that sort of switches the data away in a way that is entirely unpredictable.
Yeah, no, I completely agree. History is an imperfect guide because circumstances change, and the amount of monetary stimulus and the level of real rates at the moment are extraordinary.
Yeah.
Okay, so before we move on, let's just have a quick recap of where we are. Now, what caused the recession? And to me, the cause of the recession are really simple. Lockdowns and fear of infection leading to self-isolation, i.e. self-imposed lockdowns. And so these weren't caused by monetary or economic circumstances. And in response to this recession, which was entirely caused by policy and the disease, we've had unprecedented fiscal and monetary stimulus and a great deal of redistribution in the form of welfare payments going to the people who really need it. So where does that leave us? Well, right now, we're still coming out of recession. There are supply chain bottlenecks causing price rises in all sorts of inputs, like computer chips, but also commodities. We have partial lockdowns remaining in force. And there is some lasting damage from the recession in the form of businesses that are closed. But the economy is slowly having a natural recovery from recession when it is allowed. So the question then is, how is all this monetary stimulus and fiscal stimulus helping? I think it's overkill. And I think you're going to see side effects in the form of inflation and other things.
Yes.
And actually,
So
sorry, Richard.
I was going to agree with you, Keith. I think it's understandable why politicians wanted to do this, because they didn't want to see their economies destroyed, and doing it to the right extent, I think, was probably the right thing to do. But it's all got hugely conflated with inequality and the necessity for governments to apparent necessity for governments to make sure that nobody has anything bad done to them ever. And we've moved into this sort of surreal world where the central banks have got themselves into a situation which they can't get out of. And it's I think what COVID has done is it's simply accelerated the direction of travel. But I think it's massively accelerated the direction of travel. And as you say, the consequences are very hard to predict.
Absolutely.
I would say also that this is entirely my personal view, but you don't have an event like this global pandemic, and 2 years later you go back to normal. 15 or 20 years later, you may look back and say, well, we're finally out of that one. But it doesn't happen in 2 years.
So what's your point there, Richard?
Well, my point is we will be seeing all sorts of disruptions from the pandemic for many years to come.
Yeah, I agree. Okay, on to the weekly checklist. Richard has updated all the tables. So, Richard, do you want to do this?
That's Keith's saying if there are any mistakes in it. So, thank you, Keith. Yeah. So the FTSE had a reasonable week, up 0.74%. The S&P 500 continued its march higher, and I think reached another all-time high. The Nasdaq likewise continued with its march upwards. The topics didn't really go anywhere. Bitcoin bounced around and didn't go anywhere, and the GBP to the US dollar remained pretty much constant. And I think the dollar index went down a little bit and then it went back up a little bit, and that seems to be fairly stable around about just above 90.
Yeah, what I find interesting is the performance of the Nasdaq, and of course that's exactly what you'd expect when yields fall during the week. Is long duration tech assets go up, and that's exactly what happened. And actually the fall in yields means that the tech bubble can continue growing.
It does. I saw an interesting graph this week that it wasn't very easy to reproduce on screen, but basically it was saying that if you take the FANGs and the big tech companies and look at their valuations as a percentage of sales, if they were to revert to the S&P mean, they have to continue growing at their current growth rates for 5 to 15 years, depending on the company, at which point they have become so large that they couldn't actually grow that fast. But also it indicates the degree of overvaluation that they have in comparison to even the valuations on the S&P 500.
Yeah.
So I just think this is a useful reminder of what goes on if we have inflation. So growth stocks and inflation, prices versus value. So inflation increases the required return on your investment. So if you have no inflation and you're happy with a 5% return, if you then have 3% inflation, you would want an 8% return, all other things being equal. So currently, yes, the overall return on the S&P growth and dividends is about 5.7% per annum. If inflation permanently increased by 2 points, then the premium will move up to around about 8% per annum. And that's a 35% increase in your return, and that would require a 35% reduction in share price if earnings would remain unchanged. No, sorry, with a second bullet point, it's currently S&P has a earnings yield of about 5.7%. So basically, inflation is very bad for share prices if
Absolutely.
you don't have quantitative easing. I think you have to put that caveat in.
No, this is why you need to watch inflation expectations. Inflation expectations start rising strongly, then that is very bad for equities because the
Yeah.
discount rate is rising.
Yeah. The famous put-call ratio. So the put-call ratio is at the lowest it's ever been since this chart started. So it's a ratio of number of people who basically have got a bearish view on options versus number of people who have a bullish view with buying options, and the vast majority of people have a bullish view, and typically that's a contrarian signal. We don't know whether contrarian signals are that anymore.
Yeah.
Industrial commodities. So aluminium up 2%, cobalt 1.5%, copper down 1.5%, chromium unchanged, iron ore up 2.4%, lithium unchanged, neodymium down 1.5%, nickel down 0.9%, ferrovanadium up 1.2%, WTI up 1.87%, but interestingly, over $70 a barrel.
Yeah.
And I think that's a little bit of a watershed for it. And uranium up nearly 2%.
Commodities are just refusing to come down, essentially. The bull market in commodities very much remains intact. Now, this is an interesting chart that Richard found. And in previous weekly updates, we have covered the fact that the oil majors have not been investing in replacing their reserves. So their reserves are gradually falling. But one thing I hadn't been aware of was that the same is true for state oil companies. So PetroChina and Petrobras, which is the Brazilian state operator. So this all adds up to a picture of a future supply crunch as we consume the resources we have now. Where are the future oil supplies going to come from?
Yeah.
Richard.
So, well, the Bloomberg Commodity Index is still rising, and it's not showing any signs of stopping yet, is it, Keith?
Nope. Do you want to do all these, actually?
Yeah. So the copper is basically taking a breather, but it only appears to be taking a breather. It's not having any serious pullback, and chartists would call that a bull flag. I beg your pardon.
Right. Okay.
Are we in a copper super cycle? So the previous super cycles, we got the post-war super cycle from 1940 to 1960, 1980, the Asian super cycle, the China super cycle, and the question now is, are we going to see copper going up to, I guess, on this graph, maybe 12 or 14,000 dollars a ton? And are we in a new copper super cycle? Personally, I think we are.
Yeah. Well, I mean, the price action would seem to indicate we are. Now, the one thing I really took away from this chart, Richard, was how volatile prices have been during previous super cycles. Yeah. So if you look at the last one in 2005 to 2012, it shoots up initially, and then you have a 30 or 40% retracement, and then it bounces around. Then you have an enormous retracement during the great financial crisis. But over that period, you're investing a lot in future supply, and then finally it comes on stream. But that takes around 5 years.
It's interesting, isn't it? If you look at the sort of the chunks of the peaks, they are all roughly about 10 years long. So the peak from 1965 to 1980 or 1975, well, the three peaks, that's about 10 years, and that sort of seems to be a replicating pattern. And if that holds true now, we've got about another 9 years to go of elevated copper prices before supply meets demand, but with a great deal of volatility within that.
Yeah, very good point.
Aluminium just bouncing around near its highs, not showing any signs of pulling back. Iron ore has risen from its fairly sharp pullback, and again is looking pretty strong.
Yeah, absolutely amazing.
Lithium still staying level at 89,000. Chromium not showing any signs of pulling back. Neodymium still in its pullback. Remains to be seen where it goes from here. Ferrovanadium still in its uptrend.
Yeah, looking strong. Both chrome and vanadium are following the iron price higher finally.
Yeah. Keith?
Well, crude, this is a very artificial market in that OPEC essentially still have at least 6 million barrels out of the market, and they are in complete control. Now, frankly, I don't expect them to allow oil prices to go above 80. And I think they would be very happy with an oil price between $70 and $80. And over the next few months, you'd expect OPEC to start opening the taps and allowing barrels onto the market to mop up any excess demand. And you won't see oil really start to rise until OPEC's supply has normalized. But over the next couple of years, as we've talked about many times, there's a lack of new supply coming on due to a lack of investment. And over the next few years, I think you will see oil prices rise sharply. Now, we're going to go into this in much more detail when we do our cycle watch for June, which we hope to record during the week.
I also think, Keith, there's a social imperative on the Saudis to maximize their income from this oil cycle, because it'll probably be the last major one where they can sell large quantities at a higher price. And they'll be doing a lot of calculations that tell them how they maximize their income, and then they need to reinvest in non-fossil fuel industry.
So I disagree with that, Richard, actually, because I think, as we go into this in detail in the cycle watch, but you can look at the economy and as being the process by which we convert energy into output, both in services and manufacturing. And essentially what we're doing through ESG is cutting down on the future supply of energy, both coal and oil in particular. And we're then investing in renewables. But as we've seen previously, renewables are only about 3% of the global energy mix, the vast majority of which remains fossil fuels. And if we restrict the future supply of fossil fuels, that means we restrict future growth. And the question is, when the world economy starts to hit those constraints, because that will then cause a recession. And my vision for this current cycle, economic cycle, is that it will be quite short and sharp, because we will start to hit those constraints. And at that point, we can't grow anymore. We go back into recession. So I think this could well not be the last one, that we have a series of short, sharp recession cycles.
Yeah. Interesting. Yep. So uranium has, basically, it actually hasn't really gone anywhere for quite a few years now. And I am a uranium bull in the future. I was a uranium bull in the present, but I'm no longer that. I do think the price of uranium will probably go up substantially in the future, but not yet. Lumber, I wanted to put this chart in because it's extraordinary. This shows what happens if you get on the wrong side of commodity trade. So it went up from, let's call it 100,000 to 175,000, and now it's back down to 100,000. But most of those moves are limit down, and if you bought in at 170,000, you can't get out, because when it moves limit down, you can't sell. And so there will be an awful lot of pain in that trade, but it just shows how volatile commodity prices can be as well. This is a weekly chart.
Yeah, no, this is a great chart, Rich, and this shows the danger of speculating in commodities that have already gone up a hell of a lot. And in lumber in particular, we knew that it was all due to bottlenecking.
Yeah.
So it was inevitable at some stage it was going to come down again because
I
actually, so go on.
I was going to say, Keith, I think we've invented a new word which needs to be added to the lexicon: to bottleneck.
Yes.
I just love this chart. Keith found it last week, and I just think it's a great chart because it's a sense check. It says be careful in the commodity market because, according to Bloomberg Energy, there is a great deal of speculative demand in here, and the price is following it. So I like it. It's just a sense check for me. Don't get carried away. So precious metals, gold up 0.4%, silver was up fairly substantial 2.5%, platinum unchanged, rhodium down 2.4%, and palladium down 1.9%.
I'm surprised actually that gold and silver didn't have a stronger week on the back of the sell-off in yields falling.
I suspect that we'll see gold following through over the course of the next few weeks. This is the silver chart. Basically, it's looking quite bullish here, and there's certainly no sign of a sort of a negative thought process going on in investors' minds with respect to silver, and it looks like it's getting ready to break above 2,800 over the course of the next few weeks, I would think.
Good chartism, Richard.
Thank you, Keith. And then, so this is a graph I found of annual world silver mine supply versus global net silver physical and ETF investment. And what it's really saying is that from 2005 up until 2019, investment demand was not a huge part of total supply. 30%, sometimes a bit more, sometimes a bit less. But then in 2020, that changed, and investment demand became 73% of mine supply, and so far to March 2021, it was 71% of total mine supply, which does put a big squeeze on available silver for commercial use, industrial use, and we know that there is a big demand for industrial use for silver in solar panels, in medical supplies, in electrical conductivity in circuits, and in electric vehicles. So there is, with investment demand so strong, there is a rationale for the silver price to go up. What do you think, Keith?
Well, I take your point, Richard, and this is a very interesting chart, but I'd like to see that in the actual silver price, which actually has been quite disappointing, I'd say.
Gold equities. This is a chart by somebody who thinks that gold equities are likely to go up substantially over the course of the next few years, and whether that's the case or not remains to be seen. But I think that's the purpose of this graph, showing these nice curvy structures. I'm not. This could be the dodgy gold graph of the week, Keith.
Well, the thing is, Richard, you know that gold miners are actually, in aggregate, their cash flows are pretty much at an all-time high.
Yeah.
So I'm actually surprised that gold miners have not done better than they have, particularly since gold has bounced. Gold miners have not actually done terribly well over the last couple of months.
And with negative real interest
Yeah.
rates. I think the market will slowly catch up to the fact that they are producing significant dividends. Platinum is just in a trading range at the moment, and rhodium isn't looking too healthy right now.
Well, you do wonder about the analogy with, let's say, lumber.
Yeah.
That had a real, well, it looks like rhodium had got ahead of itself.
Yeah.
And right now, that looks a bit like a falling knife. And
Yeah.
I would get out of the way and see where it bottoms.
Yeah. Palladium, it's currently a small correction in a very significant price rise. So watch to see what happens.
Okay, and now on to rates. Now, as we've covered previously, yields fell this week, despite inflation everywhere and inflation overshooting. So, frankly, I am mystified what's going on. And the UK 30-year is back at 1.25% for 30 years, when inflation is picking up. And this is the 30-year gilt yield. If anything, it looks like it's going to break to the downside. Bonds are going to keep on going up. Mystified. Same in the US. So goes to show how little I know, Richard.
I'm minded of that long-term 30-year chart of the US 10-year, Keith, where it's in this trend line, trend channel, and it's hit the top of the channel. And the question is it going to now move down towards the bottom of the channel over the next few years, which would actually take it to the central bank rate to a negative rate?
Well, watch this space.
We'll get that graph up for next week.
Yeah, well, our favourite chart has let us down, Richard. The seasonality chart shows that we should be entering the summer sell-off period, and we ain't.
No.
And actually, this is an extraordinary year. So I think all the elements are in place for equity markets just keep on rising. So I would be wary about getting too much out of the market at this point.
I think
Although I think some elements such as rhodium and timber, clearly they've gone up too fast. But the market in aggregate, rates are such negative real rates that this could go anywhere.
Yeah.
Okay, Richard, do you want to run through your activity?
Thank you, Keith. So I had a bit of a mediocre week, really. My portfolio is down 1% on the week. I sold all of my Ethereum just actually shortly after we did last week's weekly update. And I just didn't like the way the charts of the Bitcoin and Ethereum were looking. So I'm effectively out of the crypto market now, and I will be watching, see what happens. So I bought Ivanhoe Mines, which is a copper miner, Canadian copper miner, large Canadian copper miner. I bought that as a long-term holding. I bought Garibaldi Resources, which has a large nickel resource. It's not yet in production, has a large nickel resource in Canada. And I bought some more Hecla mines. And what I haven't put here is that most of my silver miners are, as people won't be surprised, have their mines in South America. And South America is looking increasingly politically unstable with regard to resource nationalism. Peru has been threatening to nationalize all mining. Clearly, in my view, nationalizing mining in these countries would be an economic disaster for them, because they would then manage them very badly. But it's also a disaster for the shareholders. So I'm trying to slowly trim down my exposure to South American silver miners. The problem being, of course, that there aren't actually many silver miners in a safer jurisdiction, but Hecla is one of them. So that's the reason for that change. And I sold Rambler Metals and Mining, so for a loss of 10%. I didn't like the way the price was moving down. And one of my promises to myself is that I will get out of shares that move in the wrong direction for reasons that I don't understand. And I didn't really understand why Rambler Metals was going down, so I sold them.
Well, that's a very good discipline, Richard. Can I just come in on Rambler, though? I am not selling Rambler because I really believe in it. And I think the reason the current share price is coming off is that communication once again has been quite poor. And he made these, Toby Bradbury made these vague pronouncements about doing a further fundraising. And until everyone knows actually what he's talking about, and that's out of the way, I think their shares are going to struggle.
Yes, so that's interesting, Keith. Well, I'll keep an eye on it, and I may buy back in. I just don't like the way it's moving, particularly given that copper is so strong. And I wanted to be in something that I thought was probably a bit less speculative, to be honest. So this is a chart of Ivanhoe Mines, which, as you can see, has had a strong run. I should have bought when it was 200, but I didn't. So I mean,
The thing is, Richard, I absolutely hate buying into companies when they've had, price chart like this where the price has trebled. And so I think one of the differences between us is that I'm on the hunt for companies that are going to do this. So I'm happy to hold Rambler because I think the upside is a multiple.
Yeah. Well, we'll keep watching, obviously, Keith. And if I think it's going, I'll probably miss the boat. You'll turn around and say, "Oh, it went up 100% last week, Richard."
Well, let's face it, Richard, your performance is better than mine so far this year. Anyway, carry on.
That's down to luck, I think, Keith. Heckler Mining. So you can see Heckler Mining has this lovely bull flag. I do like these terms. And basically, it looks like it's the price is about to go up again. So I like the way Heckler Mines is looking. And this is Garibaldi Resources. You wouldn't buy this share on this chart, would you? But I have. So on the basis that there will be a worldwide nickel shortage, and they have a large nickel resource at quite a high concentration. So, and then
interesting.
I will keep monitoring Bitcoin and Ethereum. So these are the logarithmic charts that I showed last week. Effectively, Bitcoin hasn't moved on the week. Ethereum actually today is around about 2,300, so it's dropped a bit from there. And I do wonder whether it is actually going to meet up with that logarithmic line at some point in the future. We'll see. But that's my concern, and that's why I decided to exit my Ethereum position. Keith.
Very good, Richard.
Thank you.
Well, if your prediction is right, and it does come down to the long-term trend line, that is a lot of pain for Ethereum holders. So it's good to get out.
I don't want to expose myself to that.
Thank you, Richard. Well, like Richard, I had an indifferent week when the all share is actually up 0.9%. So that takes me to 7.7% on the year, and I am underperforming the all share, which is annoying. I only bought one share this week. I had a limit order in Jadestone Energy, which was hit while I was away on holiday. Jadestone Energy actually has quite a large bid-offer spread. So the way I play it is by putting in a limit order and walking away. But unfortunately, during the week, it had a small piece of bad news in the Maui acquisition seems to have been delayed and the share price came off, which meant that my bid was hit, which is one of the risks you take. Now, this is the chart of Jadestone versus the oil price. And as you can see, the oil price has outperformed Jadestone over the last year and a bit. And as all the oil companies should be geared to the oil price, I mean, this chart basically shows the malaise of my portfolio over the last year, in that oil companies have failed to keep up with the oil price, which hopefully at some stage that will reverse. And I think that's it, actually. So we are going to do a separate small piece on Teresa, which we covered last week in Share Talk. So thank you to everyone for watching. Please can you press like and subscribe to the channel. And in the meantime, it is goodbye from Richard Wheater.
And it is goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.